Here is what dispatchers and new owner-operators get wrong about IFTA. They treat it like a tax form that gets filled out at the end of the quarter, the way you might do a sales tax return. It isn't that. IFTA is a record-keeping system that happens to produce a tax form. The math at the end of the quarter is mechanical. The work that actually determines whether you owe an assessment, get a refund, or trigger an audit happens on every single trip, starting with the first one you take across a state line. Carriers who don't understand this distinction end up doing one of two things. They either reconstruct mileage and fuel data after the fact, which produces estimates the auditor will not accept, or they file conservatively to cover the gaps, which means they overpay quarter after quarter without realizing it. The carriers who treat IFTA as a daily discipline file in 20 minutes per quarter. The carriers who treat it as a quarterly task spend 3 days reconstructing records, pay more than they owe, and still get flagged. Same regulation, same form, completely different outcome based on what you did on the day you crossed the state line, not what you do on April 29th. Here is the concrete failure mode. A new authority runs 4 loads in the first quarter, Texas to Ohio and back. 2 round trips. The driver knows roughly where he fueled. He thinks he has the receipts in the glove box. When the quarter closes, half the receipts are gone. The ELD data has a 3-day gap from a connectivity issue in Arkansas, and the dispatcher reconstructs the per-state mileage from memory and Google Maps. The return goes in. 6 months later, the base state pulls the carrier for a routine IFTA audit, asks for source documents on those 4 loads, and finds the gap. The auditor disallows the estimated miles, treats the unsupported fuel purchases as if no tax was prepaid, and issues an assessment. On 4 loads, with maybe $1,200 of fuel tax in play, the assessment comes in at around $3,200 between disallowed credits, penalties, and interest. That is 2.5 times the original tax liability on a quarter where the carrier was actually close to break-even on fuel tax allocation. The receipts were the entire issue. They cost nothing to keep and everything to lose. Here is the right approach, and it is genuinely not complicated. Every trip needs 6 data points captured at the time of the trip. Date, origin and destination, starting and ending odometer or GPS-derived mileage, total trip miles, per jurisdiction miles for every state the truck crossed, and every fuel purchase logged with date, location, gallons, vendor, and a retained receipt. Modern ELDs calculate per-state mileage automatically as long as the unit stays logged in and the connectivity holds. Verify the data weekly, not quarterly. A 3-day GPS gap caught on Friday can be reconstructed from BOLs and toll records while the trip is fresh. A 3-day gap caught in April for a January trip cannot. For fuel, the receipt is the record, not the card statement, unless the card statement shows date, gallons, location, and vendor on every line. Scan paper receipts the same day you take them. The 4 IFTA deadlines never change. Q1 is due April 30th. Q2 is due July 31st. Q3 is due October 31st. Q4 is due January 31st. You file every quarter you hold the license, even a 0-mile quarter, because a missed 0 return still generates a $50 minimum penalty in most jurisdictions. This is where Cypress fits in. Cypress runs IFTA quarterly filing as a direct billed-absorbed service for our carrier customers, which means we are not routing your fuel receipts and ELD exports through a third-party tax service that adds a markup and a layer of delay. We pull the per-jurisdiction mileage straight from your ELD on a continuous basis, validate it weekly against fuel card data and toll records, flag the gaps in near real time so you can reconstruct them while the trip is fresh, and file directly against your base state's IFTA portal. The decals renew through us. The license stays in your truck. The quarterly return goes in on time every quarter, including the 0 quarters that catch people off guard. We also run the audit defense file in parallel, which means if your base state pulls you for the standard 4-quarter look-back, the source documents are already organized, indexed, and reconcilable line by line against the filings. The same operational logic applies to the rest of the quarterly and annual compliance stack we run direct. IRP renewal, 2290 HVUT, UCR, MCS 150 biennial, BOC 3, CSA monitoring, MVR, D&A consortium. One operator, one ledger, no aggregator in the middle, no surprise markup on the wholesale layer. If you take one action from this episode, make it this one. Before your truck rolls on the next interstate load, decide where your fuel receipts live and where your per-state mileage gets recorded, and then verify both at the end of week 1. Not at the end of the quarter, end of week 1. If the ELD is logging per jurisdiction miles correctly, you will see it. If the connectivity is dropping, you will see that too, and you will fix it before it becomes a gap in your audit file. If your fuel card statements have everything an auditor needs on every line, you can rely on them. If they don't, you are scanning receipts the same day, every day. That single discipline, set in the first week, is the difference between a 20-minute quarterly filing and a $3,000 assessment 6 months later. IFTA does not reward heroics at the end of the quarter. It rewards a habit on day 1.